Hello and welcome to this webinar on COVID-19 accounting and auditing implications. My name's Martin Howard. I'm the technical partner here at Hazelwoods. We have already, of course, started to see some of these accounting implications come through, for example, in March year ends and now some June year ends as well. But we thought it would be a good time just to give everybody maybe a refresher on some of the issues, and for those of you that haven't had to grapple with them yet, some information on the latest thinking around these accounting and auditing implications. So here is the agenda. First of all, we'll be looking at the coronavirus job retention scheme, or the furlough scheme as some of you will know it. Then we'll look at government-backed loans, C-bills and B-bills, and some of the accounting implications which might not be quite as straightforward as you might think. Then we'll go into rent and rates holidays, and there's been some recently updated thinking on rent holidays in particular. We'll briefly touch on holiday pay accruals, not something that's come out of a government-backed scheme, but something that does have implications arising from COVID-19. We'll then talk about going concern, the implications both on directors and for those of you that have audits, those as well. And then again, for audited entities, the implications of a remote audit, which many companies will have already gone through, but a good time just to think about what that means for everybody. So let's look at the Coronavirus Job Retention Scheme, or CJRS, or of course to give it its well-known colloquial name, the furlough scheme. I don't think if you went back 6 months that any of us would have thought that the words furlough and unfurlough, which I'm not sure is even a word anyway, would have entered the lexicon in quite the way they have. But it's now become a bit of a fact of life for many companies that were used to furloughing and unfurloughing, and now even flexible furloughing people. So probably time to think about what this means for how we would account for these things. The first and most important point is that CJRS is a government grant scheme, so amounts that are received are a government grant and need to be accounted for as such. It's probably going to be the case for many companies that in your management accounts it's been treated as a deduction from the payroll cost, and that's quite reasonable in the circumstances, because at an operational level that's really what it is in our minds. Unfortunately, for statutory accounts, that's not the case, and the payroll cost needs to be shown separately, with the government grant being shown as income, probably within the other operating income line in the profit and loss account. So essentially, you're going to get the same payroll cost as you would have had if it wasn't for the employee being furloughed, the amount received from the government then being shown in income, or grossing up if you want to call it that. So it's going to be important that you do keep a record of the amounts that you've received in the furlough scheme, and that if you're audited that that can be demonstrated. And also in the statutory accounts, some disclosure is required. Although, of course, we all know what the furlough scheme looks like and what it is, your accounts do need to disclose the nature of that scheme and the amounts involved. Worth bearing in mind, of course, particularly for March year ends, that the first claims on the furlough scheme weren't made until sometime into April. Therefore, there is a question as to, well, can I and should I be carrying a debtor for my first claim for those first few days at the end of March? The answer is yes. The standard setters have had a look at this and determined that there was really sufficient certainty at the end of March. The CJRS scheme had been fully announced by that point, and any companies that were joining the scheme and furloughing staff had sufficient expectation at the end of March to be able to carry a debtor for the amount of CJRS that related to March. Rolling that forward, say we're looking at a June year end, obviously by this point the furlough scheme's been well established, but if a claim had been made for staff up to the end of June, of course that would be received sometime in July, so it's important to make sure that that debtor for June is included. Some companies might be tempted to say, well, I'm not going to account for it until I've received it. That's not really the right thing to do. You should be recording it on a receivable basis and putting the debtor in accordingly. So really that's it on furlough schemes. It's relatively straightforward in terms of the accounting. It's, as I say, it's just important to make sure that the income and the cost are shown separately. So let's talk a bit now about government-backed loans. There's been various flavours of these, but essentially it comes down to what we beautifully call C-bills and B-bills. It might seem fairly straightforward, and what's happening in the vast majority of cases is that a company will be receiving a loan from a bank, but that is backed by the government, and no interest or repayments are going to be made in the first 12 months, and that's what we'll assume is happening here. We won't talk separately about C-bills and B-bills because it kind of all comes back to the same thing. You might think that's fairly straightforward. Okay, simple. We just won't account for any interest in the first year. Unfortunately, accountants don't like to make things that simple, and there is a different answer. What's effectively happening is that actually the loan that's being created does carry interest throughout the whole period, but in year one it's being paid by the government. That's the assumption I'm making. Some agreements may be different to that, so it is very, very important, I'll say from the off, that the terms are closely examined to make sure that is the case. But I'm assuming here that it's what we would normally see, that the loan is simply being supported by the government for that first year. So the question is, do you need to account for anything in the first year? As I say, it may be tempting to say no and just carry no interest. Unfortunately, the best place to look for this is the ICAEW, the Institute of Chartered Accountants in England and Wales. There's no rules around this. FRS 102 doesn't actually say what you need to do here, because it didn't really ever necessarily think that we were going to get this form of loan. So going back to first principles, the Institute advice is that yes, you do have to do something. And rather than go into detail here on this webinar, I would advise you to go and look at the Institute's coronavirus website area. It's very good. And you will find that they have given guidance here. What they're effectively saying is that you have to look at the interest across the term of the whole loan, and that will then give you a sort of a present value of the loan for all the payments that are going to be made from the start. That will then give you an imputed interest for your first year that will be carried even without that interest payment, and then you'll spread the rest of it across the life of the loan. So for the purposes of this webinar, I'm only talking about that very briefly, but I think the key message to take away here is that it's not necessarily as straightforward as just ignoring the interest in your first year. You may need to go away and do some calculations. So my recommendation would be to go and look at that Institute guidance. If that's not clear or you need some more help, talk to your accountant, ideally one from Hazelwoods, of course, and you'll get the right answer. Of course, materiality comes into play with all of this, and I'm suspecting that a lot of this will end up being immaterial. Looking at the size of loans compared to the size of company and then imputing 1 year's interest on that loan may well give an immaterial answer. So before you get too excited, do go in and check that. But it is worth having a look. Other than that, of course, the accounting for a loan is straightforward. You're going to have a loan in your books and you'll treat that as less than 1 year, greater than 1 year, as you normally would. Let's have a look now at rent and rates holidays. Many companies have gone away to their landlords and been thankfully kindly dealt with, and they've been given a waiver on the rent for maybe the quarter to the end of June. In some cases, it may only have been a deferral. If it was a deferral, then of course you would just have to accrue for the rent that wasn't paid in that period, and then of course it's paid at a later date. You would then post the cost against, or the payment I should say, against that accrual. So what we're talking about here is holidays. So there's been some debate in the industry about what happens here, because if you took a very strict IFRS or FRS 102 line without any change to that, it would have gone down the route of this being a lease modification, potentially having to spread it over the term of the whole lease. Basically an answer that didn't really make sense. Thankfully, towards the end of July, the IFRS has been amended, and the FRC have put forward a similar amendment into FRS 102, which I think we can take as read as being the right way to do things. And that, thankfully, gives you the common sense answer, which isn't always what we do as accountants, but thankfully we have come up with the common sense answer on this occasion, which is that you would take the rent holiday over the same period as the proportion to which you're expecting to take the benefit. So if you weren't able to use the property for the 3 months to 30th of June, that's the period over which you would take the rent holiday as well. So basically no rent charge would appear for that quarter, and for your year ended 30th of June accounts, you're only going to have 9 months. So really, to cut a long story short, we're getting the common sense answer, just don't take any rent for that period that you're getting the holiday. There have also been business rates holidays provided by the government. Again, that's been subject to a little bit of debate, but fairly early on got clearance on what that was. That's simply a reduction to zero cost as well. It was clear that this wasn't a government grant or anything like that. It was just the government saying no rates for this period, and therefore you can just take that as nil cost for whatever period you had the rates holiday. So really, I've gone quite a long way round of saying rent and rates holidays, pretty simple. You just take no cost where you've had no charge. So holiday pay accruals. Now, there's no financial support measure here as such from the government as there have been for the furlough scheme and the loan schemes. But you may recall that the government did allow workers who were unable to take leave due to the COVID-19 and the lockdown, they're able to carry that forward into the next 2 years on a statutory basis. So really the message here is pretty straightforward, is just to be careful, because this is going to make holiday pay accruals potentially build up. And also, as well as that, you might have to think, well, actually, is my holiday pay accrual that I've got at, say, the end of June going to unravel within a year, or is it going to take 2 years? Does that change the disclosure in terms of a current liability and the amount greater than 1 year? Again, under materiality, hopefully not. This isn't going to be a big issue, but you might just need to consider any changes in the calculation and what it might mean. So just a bit of a heads up there. Just watch your holiday pay accruals that are coming up right now. So let's talk now about those two dreaded words, going concern. Not two words that anybody likes to hear really in the context of a set of accounts, but let's remind ourselves that it is actually not necessarily a bad phrase. It is a fundamental accounting principle, and that principle assumes that a business will be able to continue trading for the foreseeable future. In the UK, what we do is we look forward 12 months from the date of approval of the financial statements. That's the key period, but the directors do have to also consider the period beyond that and whether there may be any more significant issues that might give rise to doubt over the going concern basis. So it is important as directors that regardless of whether an audit is taking place or not, that directors are able to give themselves really that support in preparing and approving financial statements, that they are able to say that the business will be able to continue trading for the foreseeable future. If not, then the directors really should be asking themselves whether they should be signing off those accounts. So it is very much the director's assessment first. And therefore, what really would be expected is that the directors have prepared some forecasts that do to some level take into account the implications of COVID-19. Now, of course, we don't know what they are necessarily. I'm recording this in the middle of August, and at this stage, lockdown has been eased. Life is starting to return to some semblance of normality. Businesses are mostly open. But of course, the cases in Europe are starting to increase. Cases in the UK are a little bit on the increase. Nobody quite knows what's going to happen in terms of local lockdowns, a second lockdown. So there is still quite a lot of uncertainty around. But of course, we do have experience now of 2 or 3 months of lockdown, and therefore what impact that might have on the business. So really, what would be expected of directors is to have some forecasts that really are their best estimate of what might happen over the next 12 months, say, taking into account a realistic and perhaps a slightly prudent approach. But maybe being able to stress test those, sensitize those, and be able to say, actually, you know what, we've got plenty of cash in the bank, we can withstand this, or maybe we haven't and there's some uncertainty. For companies that are audited, of course, the auditors are going to be looking at that closely. It's inevitable that auditors are going to be doing more work here. many companies will have already experienced this in the past few months. And unless it's absolutely clear that the company's got loads and loads and loads of cash and it doesn't really matter if COVID-19 hits again, they'll be fine. Apart from those most obvious of cases, auditors are going to need to do more work. They're going to ask for more information. They're going to ask for a COVID-19 forecast, if you like. They're going to ask if you've done sensitivities. They're going to be stress testing them. All that stuff needs to be done. But it is important for auditors that they do it on a case-by-case basis and don't just take a blanket approach that, everything's broken. Auditors should be aware that many companies are actually, if some companies are doing better, many companies are relatively unaffected and withstanding any impact. So key message here is don't ignore it. Make sure it's taken into account in your forecast. Make some reasonable and prudent assumptions. Have some sensitivities around, okay, what if the future impact is going to be a bit worse than we think? And then be able to say, actually, yeah, we're quite confident we're all right. Hopefully that is the case. And if the company's subject to audit, then be able to demonstrate that to your auditors. Really important point at the moment. So I've talked a bit about audits in the context of going concern. Many companies that have December and March year ends will probably already have had some experience of remote auditing. And it's mainly just a practical piece, really. Unfortunately, the FRC, who are the Financial Reporting Council, who oversee auditors, they've not let up at all. If anything, the expectation on auditors is actually higher right now. There's not been any relaxation of rules. Auditors are required to be as robust as they would be, and as I say, perhaps even more so in the light of COVID-19, particularly around going concern. Most auditors have been working from home, probably still are to a large degree, as are companies, and so it is important to understand what remote audit might mean. The key really to get a good remote audit done is to agree how information is going to be shared and have a really clear schedule between the auditors and the company as to what is required, how it's going to be communicated, and when, really. It's key for the auditor to have that information request list up front and to keep that updated as the audit goes on, keep query lists going backwards and forwards, and just be really clear on what information is required. Ideally, there'll be some sort of file sharing site used, so it's not emails going backwards and forwards. There's bound to be a bit of email, there's bound to be some phones and video calls, whatever it is, but keep those query lists regularly updated. Good communication is, of course, key, as we will have been found on lots of things in COVID-19 in business. Regular update calls, regular meetings, all good stuff. Agreeing on timescales is absolutely crucial. Probably, though, I think it's key to maybe be a bit more flexible than normal. Sometimes there may be external reasons why an audit has to be completed by a certain date, maybe a filing deadline, a bank deadline, something like that. But if possible, a bit more flexibility at the moment is probably welcomed on both sides. So, we just have to be aware of the various pressures that people are under and that it might take a bit longer than normal to get these things done. We are, of course, now in a position where on-site time is probably looking more possible again. Using the various precautions that we have in place around COVID-19. Auditors are able to get back on site now, but it's still perhaps more limited than it was in the past. What we're potentially seeing now for remote audits in the future and for auditing in general is that probably the auditors will start auditing remotely. That'll be the first phase of the audit, gather as much information as they can remotely, process all that information, get a good chunk of the audit done, and then have a targeted list of what is better or can only be done out on site. Go out and do that, nail the audit, job done. That would be ideal, of course. It doesn't necessarily always work in practice, but that's probably where auditing is going. So that's all I've got to say. Hope that's been of use. Good luck to everybody in getting through all this. And thanks for listening.